I'm Connor O'Brien, CEO of O'Shares Investments. With me today, Kevin O'Leary. We're going to talk about the macro outlook here as we roll towards the end of 2022. Kevin, how are you?
Very good.
Great. So obviously the headline news is all about inflation and recession and what the Fed's going to do. Let's take us to a chart here that looks busy, but it's got a really important message here, which is every time inflation gets over 6%, the Fed has to move rates higher than the inflation level. This is historic data, and every inflation period is different. What are your thoughts this time as we head towards year end and the Fed tries to crush inflation?
This inflationary period is unique. Like all inflationary periods, they start with something that often comes out from the left field, and that happened here by printing $6 trillion during the pandemic period. That's unprecedented. That's never been done before. And of course, you could expect that it would find its way into asset prices, and it has. Now, Fed mandate is to keep inflation around 2%, so they've got their work cut out for them. But at the same time, it's very hard to talk recession when you have full employment and you have so much liquidity. And so here we are in a situation where you've got very, very strong consumer data. If you go and poll CEOs of the S&P 500, they're very pessimistic about a recession in 2023, thinking they'll get one, whether it's a hard landing or soft. They can't say, nobody can. But then you look at consumer data and they're quite optimistic. And so that's unique. That's different for this period. And the outcome is unknown. And so to get a recession, you've got to have employment slow down. Haven't got that yet. To get a recession, you need consumers to dry up on spending. We haven't seen that yet. You need a collapse of earnings on the S&P. Haven't seen that yet. So if we may talk ourselves into a recession. When it happens, I don't know. But it's not happening right now. And so you've also got to remember that CPI data that is used to measure inflation does not include housing prices. It takes at least 9 months to flush that through. And so if we get a correction in housing prices, which in some parts of the market they've slowed down, but that's not reflected in CPI. So we may have solved half the problem already. We simply don't know. And that's the challenge of this particular period and this particular recession, if there is one.
Your comments align with the dot plot. You know, the Fed governors basically have the dots, the Fed funds rate peaking out in sort of the 4%, 4.5% area, whereas inflation's way over 4%, as we know. So they're not saying they're going to repeat history here and have to push Fed funds well above the current inflation rate. Let's take a look at the next slide here. It kind of is a reminder to everybody and advisors. And it's been a very difficult year, of course, no matter what asset class you've been invested in, and allocations hadn't helped because bonds have been hammered as never before, and equities down as well. So there's positive correlation instead of the usual negative correlation. How do you reposition when nothing is working is kind of the challenging question here. And I'm just going to go to the next slide here just to have some summary points while I ask you these questions. We've talked about the Fed funds outlook. Tell us about your thoughts on asset mix considerations and what kind of equity tilt makes sense going into 2023.
Well, the majority of capital invested worldwide is primarily in pension and sovereign funds. And even for individuals, the bogey's the same. It's not that complicated. Most people are looking to make around 6% from their portfolios a year. That's what it takes to live off, or support a union, or support a pension, or do distributions. So each mandate is slightly different, but 6% would be a good average to look at. So how do you do that? It's very hard to get 6% using fixed income right now, even though the 2 years skirting with 4% at 3.9. But you're still 200 basis points off your target. So in addition, if you think the Fed is going to raise rates another 75 and another 75 after that, that's not going to be a good place to put money to work. And you certainly aren't going to get anywhere near 6% as you get capital declining in value as bonds trade down, as Fed goes up. So it really points back to finding companies that have strong business models, strong balance sheets, distributing cash flow through dividend yields, and look for capital appreciation from here. There's been a reset on price earnings ratios in every sector. I don't care which of the 11 sectors you look at. There has been a compression on PEs, which is not a bad thing if you're investing now and putting new money to work. So we're sort of sitting at a 17 PE. And if you think to yourself, well, if earnings are going to be relatively stable, let's say 6 to 8%, not a bad entry point for the market, regardless of what sector you look at. But again, within the sectors, you need to find the balance sheets that have stable business models, have strong return on assets, that really have real cash flows. Because buying a company that provides dividend yields of, let's say, 2%, and you're hoping for 4% capital appreciation to get your 6% target done, you don't want one that's using debt to do those distributions. And many companies do that. That's a deteriorating balance sheet. You want strong companies that really have strong balance sheets that are generating the cash that they're distributing to you. And you can index for that. There's lots of ways to get active indexing that provides for a strong look at balance sheets and make sure the companies you own are going to be stable in terms of providing you distributions.
So you just described the DNA of the O-Shares family of indexes, of course, built on quality, companies selected because they have profitability, strong balance sheets, and so on. And that is certainly part of what we think is going to help the selection of good companies going through the kind of economic transition that we are going to go through. I just want to say thank you to you, Kevin, and thanks everybody for listening to this video, and encourage people to get more information just by sending an email, info@oshares.com. We're happy to respond to your requests for further info. Thanks very much.